What's going on, you guys? My name is Zach Hartley, and in this video, we're going to talk about trading strategy with a hedge fund manager. Here is everything you need to know. Let's go. Okay, so the gentleman that we're going to be speaking with today, his name is Dan Nye, and he's been on our channel before because he's currently the Chief Strategy Officer at Graphex. Now, that company makes spherical graphite for the electric vehicle industry, but prior to that, he was a hedge fund manager for over 10 years where he beat the market every single year. He has also been a nuclear engineer and a nuclear submarine officer, so he was actually driving the nuclear submarines for the Navy, and then he also has an MBA from the Harvard Business School. So he's a very smart gentleman, experienced in a variety of different industries, and I am very excited to speak with him. And the topics that we are going to cover today include: how do hedge funds work? What was his trading strategy? How did he enter and exit his positions? What role did technical analysis play in those entries and exits? And does he have any advice for retail investors, as well as what are the current market trends that he is seeing right now? So I guarantee you there's going to be something new that you didn't know that you'll learn in this video. And if you get any value out of this video, remember to click that like and subscribe button, and let's jump right in. Awesome, Dan. So thank you so much for joining me in this kind of conversation interview. I'm very excited to speak with you. How are you doing today?
I'm doing good, Zach. How you doing?
Good. I'm doing very well. So before we kind of get into this, can you just tell us a little bit about how you got started in the world of hedge funds? What was it like, and how does the average or typical hedge fund operate, and how do they work?
So I get involved with hedge funds through more of the traditional routes. So I went through Harvard for my MBA, then went to work at a management consultancy called Bain, then went on to work in investment banking. And when I was working in investment banking, I was introduced to a client who was a hedge fund, and that's why I managed to jump from IB over to investment banking. So that was more traditional way you go through a relationship. Nowadays, the funds are much bigger, and they recruit actively at the university. So if you went to work for, say, a Citadel, they are actively recruiting at many of the universities in the United States.
Gotcha. And then with regards to hedge funds, I have a just basic understanding, but we've got people that work at the hedge fund that bring in money from investors. They invest it for the investors and charge a fee. Is that the general structure, or is there anything I'm missing?
No, typically, so a hedge fund is a private vehicle where institutions and individuals subscribe to, and they use that vehicle to manage their money. So it's now what makes it different than a mutual fund is a mutual fund will invest long only, and it will usually invest according to very specific parameters. Hedge funds can do a variety of different strategies. So the standard one is equity long short, where you try and hedge your risk on the long side by shorting stocks. But there's merger arbitrage. There's credit funds. There are more thematic funds. There are the systematic funds that track that actually use macro drivers. So there's a huge number of different ways people try to make money, and the general term for these private vehicles is a hedge fund.
Gotcha. Okay, that clarifies things for us. And can you tell us a little bit about the type of money and the type of hedge fund that you were at, and then a little bit about how you guys operated, and how did you figure out what companies or what areas you were going to pay attention to and start investing in?
So when you think about how to invest, our mandate, our strategy was equity long shorts. So we would take positions both on the long side and hedge it on the short side. And ideally, you want to make money on both sides of that book. And within that mandate, so we structured our investment strategy using a thematic approach. So if you think about, there's thousands and thousands of equities to choose from in the US and across the globe. There's tens of thousands. So the biggest trick is to the hardest hurdle is to kind of figure out a way to take that big pool of stocks and figure out how many stocks you want to focus on. So there's a couple of methods that funds use. So they can they can use a screening method, and they go through a tool like Bloomberg, and they pick stocks that are greater than X billion, and basically are growing at Y, and maybe have a debt structure of Z. And that's one way to kind of reduce that pool. The way that we invested, we looked at big picture themes. So we would think about themes that were current and growing, and then find stocks that were benefiting from those themes. So if one of those themes were big data, you would look at companies that contributed to or part of the big data puzzle. So either they processed information, either they allowed companies to process information, and that's how you would pick your stocks or pick your pool. And the next level down would be to select the stocks you want to invest into. And then it comes down to fundamental analysis. So you have to go to the grassroots level, pull the filings, look at the financials, look at the analyst forecasts, build your models, and do real bottoms up. And then at that point, speak to management to get a better understanding of the business.
Awesome. So starting from that high point with regards to the themes, how did you determine your themes? Was this based off of life experience and going through day to day and finding trends? Was it research? Was it a mix of both? What was the best way to find your theme?
So you look at that point in time, you look at what's growing the fastest, or what's impacting now. So if you think about where we are in present time, if you want to think about themes now, it would likely be renewable energy, climate control. It would be electric vehicles, technology, which could convert your home office to a much more efficient office. So those would be kind of the themes you'd be looking at. Automation would be one, as we get as automation has advanced. So you kind of look what's happening now, and that's through reading, and that's through reading trade press, that's through speaking to industry professionals, that's staying current with the newspapers. So I mean, one of the things you, as an investor, I was always trying to do is read the Wall Street Journal and read the FT every day, and that gives you a good flavor of what's happening in the world. And Barron's also is a great source. Barron's was a once a week read for me.
Gotcha. Awesome. Okay. And so you've got that theme, and now you're diving in and you say, okay, electric vehicles, that's the theme that I like. How do you go in that scenario, let's say, what would be specific things that you're looking for to help you say long on this company or short on this company?
So you look through, so you go at the very top. So the very top of that tree would be the OEM. So it would certainly be Tesla, NIO. It would be companies which are entering that sector. So GM, Ford, BMW, VW are all into that sector. So the OEMs would be the end beneficiaries. Then you kind of go one step beneath that. So there's electric vehicles, what's inside. So you would look at the components within those cars. You would look at the batteries, what goes into those batteries, who makes the different pieces of those batteries. You look at the motors, who's making the motors, who's making the drivetrains, who's actually doing the automation behind the battery management on the software side. Then you would look at the infrastructure that benefits. So that's where you would look on the long side. Mm-hmm. On the short side, you would think about who's being disrupted, and that's the important side. So who's being disrupted? So the guys who are getting disrupted may be the semiconductor manufacturers who are making chips for internal combustion engines, which can't transition to electric vehicles. It may be the companies making catalytic converters, making diesel engines, making parts which actually are not compatible with electric vehicles. So you look on both sides of the deck, and companies which are getting disrupted would be a way to hedge your bet on the trend of companies that are benefiting. And you can go all the way down that disruption level, all the way down to the oil companies. So the oil companies will likely see reduced demand because of the emergence of electric vehicles over a long period of time. So that's how you would begin to, once you got your theme right and you had your growth rate, you always have to put a growth rate on what the theme should be. and then you can pass down to the pyramid of all the companies that will benefit and all the companies that may become the equivalent of a buggy whip maker in the future.
Gotcha. And then once you've got that, so you've got, are you, would you say that you're trying to maybe choose one company from each of those different OEM and then the battery and then the infrastructure? Do you try and diversify that way, or do you try and focus on wherever you see the best opportunity?
So you want to find the best opportunity, because usually if you think about how people normally invest, so they normally pick, it's natural to pick the biggest one that you know. So basically, but there may not be the best value in that stock. So if your general theme is growing at 20%, then all the suppliers and subcontractors should also grow at least at that level. And some will do better, some will do worse. But you want to go down and find the companies that other people may have overlooked. So those types of businesses will still see that healthy growth rate, but it may be slightly second derivative of you have to think a little bit of how they benefit. So for example, you may find a company that makes a component of a battery or a component of an electric motor that you would never tie into that, but they've been growing because of this ultimate trend. So you always want to look at the best value. And so the way you look at value, you look at, depending on the business, you could look at price to earnings, enterprise value to EBITDA. You could look at price to earnings to growth. You could look at basically what's the price to book. And you want to find a business that's going to benefit, that's the least expensive, benefiting from that trend, and likely someone hasn't picked up on it yet. So you want to be there before other investors are there.
Gotcha. And then once you've made that decision and you've highlighted a couple of stocks that you actually want to get into or you want to short them, what does your entry look like at a hedge fund as compared to a retail investor? Are they completely different things, or are there similarities there?
Well, you tend to run with a fund, you run a book, and so you want diversification in that book. So typically you run somewhere about 40 positions in a book. So you normally build into a position. So you usually buy 1% to 2% and build it up over a period of time. And that period of time may vary as to if the stock is moving, you want to build in faster. If you think that it looks toppy, so maybe it's had a run, you may want to build in a bit slower and wait for it to come back. But you want to take the position over time, and also you're getting to know the company. So you're actually you've done your desktop research, you've met with the company, and so your first step, you may know 10 or 20% of what you need to know about that business. And so you meet with them again, you do more research, you get to 40%. So as you start building that position over time, you take it from your 1 or 2%, and where you want to end up is somewhere between 5 and 7%. So your top 10 positions should account for about 50% of the book. And the reason for that is you want your conviction ideas to really make you money. So you want them to be big enough so they're going to make you money, but you don't want them to be too big in that if you get it wrong, they will damage your performance.
And is there a certain number of themes that you would kind of limit it at, or that you would try and focus on within those 40 stocks? Was there any kind of guidelines there?
I would always have somewhere between 3 and 5 themes in flight, and within that, each theme would have somewhere between 50 and 100 stocks I was looking at. So that would be my ultimate pool. So I would take a big pool of global stocks, get it down to somewhere between 150 and 400 names that I was interested in. Then you take that and build your book of 40 stocks. And then over time, as the themes reach their potential, and they may get extended, you will find something else to replace them. Then then you'll gradually wind down a theme, pick up another one, and that's a natural course of actually investing in kind of really interesting growth equities.
Gotcha. And would you take all of those same principles and apply them to retail investing on your own, or for instance, myself and what my audience does?
I think it's a great way to invest. So if you have conviction, if you it takes a lot of it takes some of the risk away. You can never reduce risk in stocks, by the way. You can never reduce it. So, but if you invest in a sector which is showing extraordinary growth and there are strong drivers behind it, then if you have a diverse portfolio of stocks to play that, then some may work, some may not, but overall the performance should be above the market. So so it allows you just to stay focused instead of actually chasing ideas as they come up. It allows you to think about things and actually try and play a certain theme. So for example, if you invested in internet stocks in kind of the late 90s, so some of those stocks would have done great and still be around today. Others of them have gone away. But if you had that diversity and picked names that were really taking market share, you would probably almost certainly have Amazon in that portfolio and have done extraordinarily well.
For sure. Now, when it comes to actually going in and making those purchases, how does technical analysis factor into those purchases as a hedge fund and then as a retail investor for yourself?
So there's actually two trains of thought in it. There's some investors who are very, very devout fundamental investors. So they would never look at a chart. And on the other side, you've got some of the trend followers who it's all about the chart. So the chart gives you information. So you can't, it would be, in my opinion, it would be a disservice as an investor not to observe that information. So when you enter a position, it's, in my opinion, important to see what the chart is telling you. So if the chart is having a very powerful run, you may want to hold off on kind of taking a big position because you don't know how far that run is going to go, and it may see a substantial pullback. So if you have a stock that's actually come back and it's formed a nice long base, so all the selling is out of it, and then importantly, if it doesn't sell down on bad news, it means the bad news is probably priced in and it's a much safer entry point. Whereas if you're buying a stock that's had a huge run, you may get stuck in that ramp, and you may find that your entry point is substantially higher than what you would have hoped.
Gotcha. And so when it comes to the technical analysis, you're looking at it as kind of just trying to understand what the price has done and what the stock has done over the last 3 to 6 months.
So it gives you a hint on entry points. So if you kind of think big picture is your stock screening, and that stock screening is either fundamental analysis based on the public information, or it's looking at a thematic viewpoint. Those are both very valid ways of screening. The next step is doing your analysis on the stock, and that's securities analysis, Benjamin Graham type stuff, to make sure that you're buying a name which is a good value, and a good value, and the price may be the multiple you pay for a growth company is likely substantially different than what you pay for a low growth company, but you need to price that in. So when you buy is what the chart tells you when you buy. So the chart gives you indication of when it's time to buy, when it's time to buy more. And so it allows you to, gives you information on timing your entry points, and again, time your exit points also.
So that was going to be my next question: is your exit point, is it more so based on technical analysis, more so based on what you're seeing with the overall theme, or like you said, kind of a combination of both?
You need to have conviction when you buy that stock. You've got to have conviction on it. So when you do your work on that stock, you need to ascribe a target price, and that target price should be based on on your assumption of where the earnings or EBITDA can go, and you set that according to multiples. So you should have a target price when you enter that position. Times change, so basically you don't want too much style drift on it, but it's okay to adjust those expectations if the company does better or company does worse. So and so then when a stock reaches that target price, you should be thinking about selling it. And if the stock is having a powerful run, it's okay to actually experience that run and trim a little bit on the way up. But you should be very much thinking about exiting a position when it gets your target price.
Gotcha. Now, with regards to risk mitigation, I know you said that you're going long and short sometimes on those companies. Are you ever putting in a stop loss? Are you ever specifically hedging against one security? Are you using trailing stop losses? Is that a thing in the world of hedge funds?
Stop losses can get you in lots of trouble because you can have market dislocations that happen sporadically. And those market dislocations, if you have stop losses in place, you can be out of position and the stock can be back where you started in almost a blink of an eye, it feels like. So funds generally don't have stop losses, but they have so they have levels. When a stock reaches a certain point, you need to think, do I buy more, do I sell, or do I hold? So you've got to make a decision, but it should never be an automatic stop loss. And so as far as mitigating risk, using diversification is the simplest way to do it. So if you look at Markowitz, who was a portfolio theorist, said that 12 to 16 positions would give you substantial diversification. You probably need a bit more if you're investing in growth stocks, investing in a certain jurisdiction or a certain kind of area. But diversification is the most important way to mitigate losses. And so if you want to hedge the investments, then having short positions can help you do that also.
Gotcha. Awesome. Now, a couple of last questions because I don't want to take up too much of your time, but what was the best kind of lesson or thing that you've learned as an investor that you would recommend or you could pass on to retail investors? What was the one piece of knowledge that kind of changed things for you?
So it's very simple. You have to have conviction in your ideas. And two things, actually. You must have conviction in your ideas, because the stock market is incredibly punishing. So when you do all your analysis and you've got it right, and basically stock doesn't go your way, then you need to have conviction that you need to go back, make sure you got it right on your analysis, and then have the conviction and the strength to hold. The second most important thing is admit when you're wrong. And if you've got it wrong and the stock doesn't go your way, and there's a clear reason why it's not going your way, then you have to admit you're wrong, cut the position. The worst thing you can do is hang on to it and then hope it goes back up, because in all likelihood it won't.
Understood. Now, you kind of covered this a little bit earlier. My question was going to be, what are the emerging trends and the themes that you're seeing right now? But you kind of touched on a little bit of it there. Is there anything else that you're seeing with regards to emerging trends? Anything in AI, machine learning, any of those kind of hot topics that get you excited?
Yeah, automation is still a big theme. So automation includes increasing efficiency in factories, increasing efficiency of office workers, and there's many companies using robotic process automation to actually begin to do those functions. Automation will continue to follow those trends, but by far I think the most exciting trend now is electric vehicles, and it's very clear the progression that's going. And to me, you can see that it's almost unprecedented government support. You've got powerful drivers from global warming. So to me, I think it's the most exciting area to invest currently.
For sure. I definitely agree with that. And I'm really excited about it too. Now, Last question here is there's a lot of talk in the current market space about inflation. Can you tell us a little bit about your opinion on the current situation with regards to inflation, and does it factor into your investment decisions?
I would be concerned. I'd be very cautious about inflation currently because it is everywhere and it's hidden. The only thing that hasn't really gone up is fuel. And so that's gone up recently, but it hasn't gone up a great deal. So inflation has been around for a long time. It's being seen now in real estate, in things like classic cars, paintings, wine. There's been powerful inflation drivers. And only now are we beginning to see inflation in food prices, inflation in actual necessities. So where there's inflation, there will have to be interest rate rises at some point. So it depends on how dovish the central banks are. If central banks continue to be dovish, they may not raise rates for a while. But as soon as rates go up, rates are usually negative for the stock market. So that's one sector I would be extremely cautious about.
Understood. Last question. I know I said that before, but you mentioned analyst forecasts, and I had somebody ask me about this earlier this week. How much weight do you put into analyst forecasts when looking at positions or when doing your research? Are they important to your decision making, or are they just kind of a resource to give you another opinion?
So yeah, so it's very difficult to predict the future, and particularly a couple of years in advance. So you always have to, for more distant analyst predictions, you need to be very, very cautious because the next, they may be quite accurate on the next quarter or 2 quarters out, but the further you get out, there's more, it's difficult to be confident in it. But fundamentally, I would always do your own work. So do your own work, do your own prediction of what you think the EPS is going to be. Where analyst predictions are important is the short-term transient you get. So if the company misses, then you can get a powerful sell-off. If it beats a little bit, you can get, a 3 to 5% rise. If it beats it a lot, and then you can see a much more powerful rise. So it adds more volatility. So you have to be somewhat kind of, I would always look at the beat history, the beat or miss history. So if you get big movements around the prints, it's something to be cautious of when you enter that position, because you may have more volatility in that stock than you would like.
And more analysts might mean more of that volatility around those prints.
No, so when you get more analysts in the stock, they tend to be really close. So the expectations are within a couple of cents each. So if you have lots of analysts, then the stock is pretty well covered, and the companies will be experienced in kind of helping the analysts kind of get comfort with their business, and so that the numbers will be much more accurate. Where you kind of get where you can get powerful moves when you have only a couple of analysts following it, and they may be wildly apart. So there is just less. It may not be, the analysts may not be putting as much work as they do if they were, say, covering Microsoft. So they may not know the company as well. They may not be as experienced in that particular company, as experienced in that particular sector. You get more volatility, in my opinion, when you have only a couple of analysts following it.
Gotcha. Understand. That makes a whole lot more sense. Dan, thank you so much for your time today. I sincerely appreciate it. This was absolutely phenomenal knowledge. And last thing is, would you like to share anything else with us? Is there anything you want to tell us about graphics and what you're doing now? And is there anything else you'd like to leave us with?
Yeah, for example, so part of the reason is it's part of the reason I'm so excited about the electric vehicle explosion. I mean, I work as the strategy officer with Graphics Group, which basically makes spherical graphite that is used in the anode for the lithium-ion batteries. So basically, it's so I'm actually not only extremely excited about it, I'm actually working on the sector. So it's I think it's got lots of room to run.
Very exciting. I will throw the ticker up right now so people can check it out, and I will link to our previous interview. Thank you so much for your time. I sincerely appreciate it.
Great, thank you.